Welcome, empowered investors. Thank you for joining us today. First of all, I want to express my heartfelt thanks to all of the condolences about my wonderful dog, Coco, who passed away just a little over 2 weeks ago. And, everybody says their dog is special, and I agree, every dog is special. But the difference with Coco is a lot of you met her because she attended all of our conferences except the very last one, Empowered Investor Live. She attended my conferences for 13 years, even as a little puppy, and a lot of you met her. So anyway, thank you so much. I really appreciate all that. But first, we have U.S. home sales increase, but the uptick could be fleeting. Higher mortgage rates are exacerbating affordability woes, analysts say. Well, did you really need an analyst to know that housing is unaffordable? Yeah, it's quite something. So a little bit of an uptick in the market for sure. We're kind of feeling that a bit too. But overall, I would still argue that we're in kind of this doldrums, right? When I took sailing lessons, and for those of you sailors out there, when I was sailing many years ago and doing beer can races and all of that kind of stuff, they have an expression when you are just in this exact wrong position, your boat is in the wrong position. They say, you're in irons. I guess that came from the pirate days, probably. So when you're in irons, you can't go anywhere. And, the market is not in irons completely, but it is a little bit. And it has been for quite a while now. And that's kind of how it feels, just sort of not going anywhere very fast. Prices appreciating very modestly, but at least appreciating overall. And that's what we're in. But remember, here's the mistake so many people make. And I'll just remind you again and again and again of this as I have before. And that is that it's a multi-dimensional asset class. And so if it's not about the sales market and it's not about big capital appreciation where prices are going up at a rate of 10, 20, 25% annually, right? If that's not happening, then what else is happening? As long as the population is stable or increasing, then we have a situation where those people, those would-be home buyers, are forced into the rental market if they're just coming out of, getting their first place to live as an adult, right? Or if they're in the rental market, they're forced to stay in the rental market, and that puts the upward pressure on rents. So as landlords, either way is fine with us. In fact, I would argue that the in irons market, where you're just kind of doing the boring but very fundamental, very important stuff of managing and hopefully self-managing your properties, then you are in a position to really, really do very well because you've got that modest appreciation going for you. You've got good cash flow and not a lot of new people coming into the buying market as sales activity is down, between 20 and 25% in most places. And that's a good time to just see your rents go up and your investments just solidify and get better and better and better. Most people don't think of that. All they do is they watch the sales prices and they are only seeing one little dimension of this wonderful multidimensional asset class. Okay, purchase payments. So mortgage payments, we don't talk about this very often, but our friend Mike was out with a new chart, and I wanted to share this with you. He doesn't usually share this stuff either, so this is kind of different, but it's really important to look at mortgage payments. So the typical single family home purchase payment that's on a purchase, not a refinance or an existing owner, which has a much lower, cheaper payment, right? Because those people won't sell because their deal is too good to sell. So that's the mortgage lock-in effect we've talked about ad nauseum. But here we look at new purchasers and what is their mortgage payment. Well, as of this month, it's exactly $2,400 a month. And remember, that mortgage, that interest is deductible, of course. So, the typical home buyer tax bracket would be somewhere in the ballpark of maybe 30%. So basically, almost a third of that is being paid by the government, right? Well, let's just do the actual math here. Let me grab my calculator. Boy, it's amazing how little we can do in our head anymore, right? It's really scary. we'll take $2,400 times 70%, and that is $1,680. That is the real mortgage payment on average for most households, right? Just very roughly back of the napkin math. But it's even better when they include the equity pay down, which isn't included in that. The payment gets cheaper. And then, of course, the appreciation, the payment gets dramatically cheaper, even with low, moderate appreciation like we have now. So it's not a bad deal to be a buyer right now. And it just makes me think that a lot of it is just because prices aren't going up at this radical, feverish pace. Human beings, they're not motivated by kind of this bland, relatively positive environment that we're in. They're motivated by fear of loss, right? If prices are going up fast and they are afraid they're going to lose out, that is going to be the most powerful thing to get people buying properties. But remember, when they buy a property for their first home, they move out of a rental property, okay? So it's not all good that the market is booming. A lot of times it's better that the market is just like it is now, just this kind of sort of partially in irons market, like we were talking about with the sailing metaphor a moment ago. And that's not bad at all. Okay, so that's the typical mortgage payment, and it's actually lower slightly than it was last year at this time. The mortgage payment is slightly lower than it was last year. Now, you can see back in 2022, like in January of 2022, it was way lower. The COVID era brought us mortgage payments that we will likely never see again. Well, never say never, but until they manufacture the next crisis. Okay. All right. So available inventory. Inventory is just kind of the same. Not much changing here. 719,000 homes on the market in the entire country. It's 32% higher than it was last year, but last year was also historically low, and it's still historically low, only about half of the 2015 normal benchmark, right? That benchmark is old, it's out of date because we've added a lot of population since 2015, but what experts consider normal, about 1.4 million homes for sale, we're at half that. So inventory is still very, very low. All right, I talk about commandment number 3, thou shalt maintain control. And I advise you to whatever degree possible, if you are in the wealth gaining stage where you want to still accumulate wealth and not shift it into neutral and just kick back and give your money to the stock market, to the modern version of organized crime, okay, then you need to be a direct investor. That's how I made all my money with real estate, being a direct investor, right? That's where I got the best returns of all in my own businesses and my own real estate, that I was a direct investor. I was the actual owner of the property, or technically maybe one of my entities was the owner, but you know what I mean. Still controlled by me. And when I say be a direct investor, I say commandment number 3, thou shalt maintain control. You decide what to buy, where to buy, when to buy, how much to rent it for, who to rent it to, when to sell it, when to refinance it, whatever, right? It's your deal. You are in control. And when you're in control, you prevent the 3 major problems of not being a direct investor. Problem number 1, you could be investing with a crook. We all know the stories of all the crooks in Wall Street, syndication deals, cryptocurrency deals. I mean, there's just so many crooks out there now. I think a crook was pitching me on a deal just about 45 minutes ago, who called me up on some, I inquire about a lot of things, right? A lot of ads I see, I inquire because I don't want to know what they're up to. This is market research. I mean, and maybe occasionally I'll actually, do the deal and invest in it. But a lot of times I just inquire to see what's going on out there in the marketplace. And, this guy's pitching me on this autopilot business that I can give him, $35,000 to set it up for me. I am 99% sure that's a scam. And, when I say scam, it's like to one degree or another, right? There just aren't any really easy answers in life. Everything involves commitment, work, risk taking. You gotta take a risk, right? You gotta do things to create wealth and make stuff happen. So first problem, you might be investing with a crook. Second problem, you might be investing with an idiot. Third problem, when you are not a direct investor, they take a huge management fee off the top for managing the deal, whether it be the executives, the CEOs of the company, or the real estate deal, the sponsor of the syndication, whatever it is, right? They take a giant management fee off the top for managing the deal. And a lot of these fees that you are being charged that's reducing your rate of return are very opaque. They're very unclear. You just never really know all the ways you're basically getting ripped off. Well, I just wanted to share this one example. Okay, Brian Niccol made 6,600 times what a barista made company says. Okay, since Brian Niccol was hired at Starbucks in September, it's hard to argue his compensation hasn't been grande. A new company securities filing shows that the chief executive and chairman has collected $96 million, the Wall Street Journal reports, most of which was in bonuses and stock awards as incentives to accept the job. The company paid an amount that is, and listen to this, it's 4 sixes in a row. At least it's not 3. That would be satanic, right? 6,666 times what the Starbucks median employee, a part-time barista, made last year of $14,674 in wages, and they get stock too, right? The company said the Niccol's package breaks down this way. His compensation, a 61, and I'm going to round this off just for speed, $61,000 salary, $5 million bonus, and a $90 million in stock awards. The stock piece largely tied to shares he forfeited when he left Chipotle Mexican Grill for Starbucks. Another $5 million in bonuses is due Niccol's in February. Well, this article's a couple months old, so he probably got his $5 million already. Okay. Expenses, $72,000 for air travel. Now, actually, I think that one's actually a little bit low, to tell you the truth. I mean, assuming that's private jet travel. I don't know. Starbucks probably has a few private jets, and that's not included in this. So that might just be commercial travel. Who knows? Maybe he took, first class on Emirates to fly over to, the Middle East to check out Starbucks over there, right? And that'll be a $20,000 per person ticket right there. Who knows? He got another $144,000 in temporary housing and almost $700,000 for security modifications to his home. Wow. A $700,000 alarm system, fence? I mean, how do you spend $700,000 on security modifications? That must be a fortress. Okay, he lives in California and commutes to Starbucks' Seattle office on a corporate jet, a perk he won in negotiations. So yeah, that tells us that the $72,000 in air travel does not include the Starbucks jet he gets to use. Okay, a perk he won in negotiations. The company said he's also traveling to areas where stores most need intervention. Okay, go have a latte in the most beautiful places in the world, right? So, this is it, folks. This is what's happening. If you were a shareholder in Starbucks, I mean, Starbucks is really having problems right now. They're on the rocks. The company is not doing well at the moment. That may change, of course. But all of these executives, and this is just the CEO, right? All the other C-suite people, they're just skimming the money off the top, folks. Okay. Even if you got a good return, say you got your, 8% return, right, on your stock, which would be fantastic. Even if you got that, you should have received 12%. There are so many ways they're just stealing from you. Too bad there's not a DOGE, Department of Government Efficiency, for these publicly traded companies, right? There should be. There should be a DOGE for that. Okay. Here's a chart that shows CEO pay is up 997% since 1978. CEO pay is up almost 1,000%. Now, remember, this is opaque, right? It's probably up much more than that when you include all of the different ways they're compensated, many of them we just discussed. The percent change in CEO compensation, stock prices, and typical worker compensation from 1978 to 2014, okay? Here we show the typical worker pay went up by 10.9%. That's pathetic, honestly. That is just totally pathetic. See, this is where I sound like Bernie Sanders, right? That is just so wrong. The workers should get paid more, right? But it only went up 10.9%. The S&P over that very long period, 503%. But the CEO pay, which in my opinion should not be allowed to outpace the S&P, it went up by double that, 997.2%. Folks, thou shalt maintain control. It's my commandment number 3. Be a direct investor. Do not get ripped off by crooks. Do not get ripped off by idiots. And do not get ripped off by people who just simply are charging big management fees and skimming the profits off the top that you should be getting. Okay, remember to register for our Wednesday masterclass. That's the second Wednesday of every month. Go to jasonhartman.com/Wednesday, and I, yours truly, will be hosting the masterclass this time. So we aren't doing a big guest or anything like that this time. It's me, yours truly, and I'm going to talk to you about how to extract wealth from your real estate portfolio and a bunch of other things. You'll be able to ask me questions in the flesh, in person, and it'll be great. So jasonhartman.com/Wednesday. This is totally free, no strings attached. We do it every month. jasonhartman.com/Wednesday. It's a Zoom meeting. So it's very open. You can ask me questions. I'll be happy to answer them on anything under the sun: self-management, financing, market condition, market projections, whatever you want to talk about. Okay.